Tesla is currently imploding. The valuation of the Tesla stock is in free fall. And so is Bitcoin, right? Bitcoin also went down quite a bit in this year. In this video, we want to look at the relative valuation. How is Tesla doing relative to Bitcoin? Why do we want to look at this? We want to look at this because the investor base has a quite large overlap, right? The people that are invested in Bitcoin are very likely also invested in Tesla and vice versa, right? These are young people, retail folks that are risk-seeking, that are technology interested. So very often you have people that are invested in both. So looking at how is capital shifting from one asset to the other might be interesting, because we can kind of distill this whole implosion that tech in general got, right? Now we have rising interest rates. Rising interest rates mean we have to discount future cash flows further. So this hurts the growth stocks the most. So all of risk is going down in valuation, but what's actually going down most? How is relative valuation happening? Because this way we can probably shuffle our assets within the portfolio somewhat and overweight the things that are comparatively cheap and sell the things that are comparatively expensive. So let's look at this. This is the chart you have very likely not yet seen. This is Tesla denominated in Bitcoin. And what I find interesting around this chart is that usually we have very often in these charts some kind of a trading range, and we see reversals when a support is being hit. So we see basically momentum flowing from one asset to the other, right? The attention is moving from one asset to the other. What's interesting around this chart is that Tesla, even though it went down so much, it's not yet at historical lows. We have been way, way lower in July of 2019 and in November of 2017. So how much lower could we go in case we would see these kinds of very low Tesla valuations again in the future? It's another 80% underperformance. So this doesn't mean that the Tesla price has to go down 80%. It could be some kind of a mix, right? The price of the Tesla stock might go down a few more percent and Bitcoin might go up quite a bit. Currently, Bitcoin is relatively well performing versus the Nasdaq, for example. But this is currently the state. So even though Tesla went down a lot, it's not yet that undervalued compared to Bitcoin as it has been in the past. Now, why are these relative valuation charts so useful? Let's look at, for example, something like Alphabet, okay, Google. So the Google stock. When I just look at the Google stock in isolation, this is what you see, right? Pretty much up and to the right. This is a long-term chart starting in 2019. Very nice performance with, of course, now somewhat of a decline due to rising interest rates. Now, when you look at the Nasdaq 100, similar chart, right? It goes up into the right with a recent decline. Now, was it a good idea to invest in Alphabet compared to investing just in Nasdaq ETF? Was it worth it to put on the idiosyncratic risk of a single company versus having a diversified portfolio with the Nasdaq 100? In order to answer this, we look at the Google stock and we divide this by the Nasdaq. Okay, Google relative to the Nasdaq. How much is Google stock worth compared to the index? And this is what we get. And this is why these charts are so useful. We see that there is usually some kind of a trading range happening. So let's zoom out a little bit. We saw an initial strong outperformance of Google, but since 2006 even, we have pretty much a trading range. And sometimes a lot of eyes are on Google, maybe because Google is bringing out a new product, maybe they released really nice numbers. And sometimes Google is relatively cheap. And the reversals are happening in pretty much a similar range, right? We can just draw something. It's not science, as in it's not perfect. We can't perfectly time this, but still you can see if you sometimes shuffle around your portfolio, when is what comparatively cheap and expensive. So let's say you have to take out some money out of your portfolio and you're thinking of what should I potentially sell? Do I sell my ETF of the Nasdaq 100 or do I sell an individual stock? Looking at these relative valuation charts might make sense, right? And you could consider, okay, I should have sold some Google stock around February of this year. So that's why this is so useful. You can use this in all kinds of contexts. So let's look at Tesla relative to the NASDAQ. This is that chart here. When you look at this on a linear scale, this is pretty much the implosion you currently see. This is the logarithmic scale. And here, the top to the bottom, in terms of underperformance, how much worse did Tesla do compared to the NASDAQ? We have a 62% roughly drop from June of 2017 to May of 2019. If we look at the current drop, happened obviously way faster, it's a similar magnitude, 62%. So we have seen similar kinds of bad performances in the past. Now all the headlines say Tesla has rarely seen as much of a price decline as now in the past. It's like an historical decline. But what I would say is it is only a historical decline in terms of US dollars because the general market is doing pretty bad. If the general market was similar to the past, then we have seen similar reversals, similar declines of relative valuation before. Okay, so simply just in terms of underperformance, this is still more or less within range, even though, of course, the current drop is way, way faster than what we've seen in the past. Okay, and this is obviously also due to some fundamental reasons, as in the manufacturing issues in China, etc. What do I personally like to buy, right? No investment recommendation, but I simply just want to share my ideas here. I think the relative valuation or the relative movements in the very long term of Microsoft to the NASDAQ is not too bad at the moment. Let's look at this very long term. So this chart here starts now in 1999, and look at these massive swings, right? This was due to the dot-com bubble. Currently, Microsoft tends to outperform the NASDAQ since 2015, okay? So for 7 years roughly. And why is this so interesting? Because also fundamentally, Microsoft has a few interesting things. There's now all this buzz around ChatGPT, and Microsoft is very heavily invested in OpenAI that released ChatGPT as well. This is a pretty good windfall. Then we've got obviously Azure that's rolling out and continues to grow quite a bit, making competition to AWS and Google Cloud. So this is the kind of things that I think might be worth putting some idiosyncratic risk in within a portfolio. But of course, in the end, having something very diversified, such as an ETF like QQQ, makes all sense. Now, should you go rather hard on QQQ or on SPY? Like, does it make more sense to invest in tech stocks or into the stock market as a whole? Like, should you go with NASDAQ or with the S&P 500? For that, we can still, again, use relative valuation charts, right? So this is, again, a very long-term chart. Let's zoom out as much as we can to 1985, okay? So this chart starts in 1985. And we can see the nice dot-com bubble over here in 2000. So the NASDAQ, the technology stocks, underperformed traditional stocks by roughly 68% in these 2 years. Okay, this is the dot-com bubble. But what we also see is that over the very, very long term, tech tends to outperform traditional stocks, which does make sense, in my opinion, because you've got all the economies of scale in tech, right? Once you have a product market fit, you can scale pretty much to infinity and print money. In traditional stocks, very often with scaling, you have more capital requirements, you simply grow slower, and you usually also have less margins, right? The marginal cost of adding a new customer to your base is way, way higher for traditional companies compared to tech. And so you do see an outperformance of tech versus traditional stocks over the very long term, of course, with volatility. Now, where does this volatility come from? It comes obviously from these hype cycles. It also comes from monetary tightening. So currently, the underperformance of the NASDAQ to the S&P 500 is roughly 21%. Now, why does monetary tightening hurt tech stocks more? It's because the main value of a tech stock is in its future cash flows far out in the future. tech stocks tend to be more expensive relative to their income. Okay, so you've got your cash flow that the tech stock might pay out, but that cash flow compared to the valuation of the company is relatively low, or the valuation itself is relatively high. And the reason for that is because people expect tech stocks to grow faster. Okay, they expect that a lot of the money will actually be generated further out in the future. Now, when you increase interest rates, the risk-free rate obviously goes up. Okay, so making money risk-free by just depositing in bonds becomes more attractive. Now, it hurts tech stocks more because in finance, what you do is when a cash flow is very far out in the future, say 10 years out or 20 years out in the future, you have to discount that cash flow more. Okay, so money 20 years from now is worth less to you than money today, right? You rather have the money today than 20 years from now. And in order to value that cash flow 20 years from now and to basically reduce its value because of the time preference of money, you divide it by at least the risk-free rate to the power of the number of years. So the cash flow that's 20 years from now, you have to divide it by, say, 1.05, when 5% is interest rate, to the power of 20. And the higher the interest rate goes, the more you have to divide this cash flow by, so the less attractive it becomes. So raising interest rates really focuses the economy on rather short-term gains, on what happens in the next few years. When you lower the interest rates, you can go for the moonshots, because then even a cash flow far out in the future is valuable to you. But once interest rates rises, it's much less about the moonshot ideas, it's much more about generating money right now. That's then where all the valuation is. And so that's why growing companies that have a lot of future expectations, they get hurt most by interest rates rises, because you have to discount these future cash flows more. Now, do I think that this very long-term trend, right, this 35-year or 37-year chart that we see here will reverse, and that traditional stocks are likely going to outperform tech stocks again? I don't think so. I think tech is here to stay. I think tech is likely going to take over more and more share of the overall economy. And I do think that tech is likely going to outgrow, say, the pharma companies, the food companies, the energy companies. That's, I think, the most likely scenario. And so for a very, very long term, I think it still makes a lot of sense to rather dollar cost average into QQQ, into tech stocks, than into very passive, very risk-free assets, if you still have a long investment horizon in front of you, right? If you're still young. That being said, right, whenever taking idiosyncratic risk, whenever buying a specific stock, I think it makes most sense not to look at the stock in isolation, but to look at it relative to whatever your benchmark is. And this should be, for tech stocks, at least QQQ. So look at any stock you have. Let's say you're interested in Amazon. Look at Amazon and then divide this stock by QQQ and then think, do you like what you see there or not? Right? So this is, for example, now Amazon. So this is what you really should be looking at, in my opinion. It is, do you think Amazon will outperform the general tech market? And if yes, it makes sense to buy. If you think that's not the case, it doesn't make sense to buy. But don't just buy because you think the US dollar valuation will go up, because stocks over the very long term go up anyways in US dollars, right? Then you can simply just buy the ETF. The only reason to get into idiosyncratic risk, into betting on one specific company, to basically take away a diversification benefit, is if you have a strong belief in that particular company doing better than the average, right? Don't just spray and pray. Instead, bet on the few horses that you think will outperform, and for all the remaining capital, put it in something that's very diversified, a very safe ETF. If you found this useful, feel free to give this a thumbs up. Feel free to subscribe as well. There's also a Telegram group in the video description. Feel free to check that out as well. See you in the next video. Bye-bye.